This is a review for Friday, the 1st of August, mainly focused on this gold long opportunity, and then going over a few other things as well, but I'm just going to start off with doing a top-down on trading view of this particular gold opportunity. It's an extremely high confidence trade that's, I was very, very confident in taking this, and as you can see, I got shaken out just before the move, so I want to go over that as well. But first, do a really brief explanation of this, then I'll jump over to trading view, do a top down, and then we'll come back and then look at what I could have done differently here. But as far as executions go, initial entry as we dropped into my point of interest, as we got this market structure shift here, and it got long, risking about $200. As you traded up, as soon as we hit that impulse high, I took a partial with the plan of adding it back on if we close back up there. And as you can see, we end up selling off and I got stopped at break even just here. So very nicely played for this section. And it works really well just taking a partial there. And had we then continued pushing up back up through, I would have added back on. So that put me green on the day, and then half of it got stopped at break even. Then in this area, I was expecting a breakaway gap in here on the 1 minute charts. This was based on the 15 second. This was based on the 1 minute. Entered long with my stop just in here, got stopped out, and that's what I expected to be a breakaway. We then continued to push higher. I got a low time frame 15 seconds model entry in here, really high resistance on the push up, and I was monitoring this high as we hit it, and when it started rejecting aggressively, I took a partial, then got stopped on the remainder at break even. Drops down into the range, consolidates a bunch, and at that point I just left it alone and was watching it all the way through up here. Had a potential entry that showed up in this area, but I didn't take it, and missed the move, unfortunately. One thing I did notice, which I'll go over the rest on TradingView, but that's the executions anyway. So really like how I executed in this area right here. However, in this area, could have done it slightly differently, and but we'll go to TradingView anyway. So I'm going to do a quick top down. Might as well start on the weekly, just to show where we're at. Weekly consolidation range, we're going to consolidating on the weekly. Range bound means we're going to bounce from one extreme to the other extreme of the range. Also, the fact we're in a consolidation means that unless this is a reversal, we are going to continue higher next. So I am bullish on the high time frame, but currently I'm looking for us to draw down to these relative equal lows. So that's where we're at the moment. My bias is bearish on the high time frame. Last week had this big rally and then an aggressive sell-off into Friday, and then that's Monday there. We had already dropped in and taken out a significant amount of sell side. Throughout this entire drop down, we'd been held at a discount all the way from Thursday onwards. Thursday and Friday last week, we remained at a discount below some key opening prices throughout the day. So I was expecting us to reach back into this area. We've also got the old previous week hype here. That's kind of my draw at the moment. But essentially, after hitting all the sell side, I was expecting us to run back up. Also, perfect equal daily highs in this area. And this was my point of interest today, which is the previous week low that we had just run. So I'll mark these out as points of interest. So previous week low we just run, that's the interesting point. Drop down to the 4 hour just to zoom in gradually. There's that previous week low. Clearly hit it on Wednesday. Thursday just rallied straight back up and then began pulling back, and then that's where we're at today. And as you can see already, we dove into that during the Asia session today. Perfect equal highs on the daily chart, with the Tuesday's high and then Wednesday made perfect equal highs and then sold off into this point of interest. As you can see, we've got fairly smooth highs all the way up through this range, including here from Friday. We have multiple smooth highs, and then Monday came really close to them but failed to take out the New York session high, meaning that we've got a lot of liquidity built up, as well as being held at below opening prices all the way through this range. Next thing I want to look at on the hour is how we have a new day opening gap from this old previous day. This is something that I've noticed works really well for narrowing down focus for new day opening gaps. So if I draw out this new day opening gap and then bring it down to the actual opening price, so quite a small area, but that's a point of interest I had. And yeah, it's simply because that is the previous day low that we just ran out, and so that's now my point of interest. That's not super relevant to this entry, however it does come into play over in this area. To keep the charts clean for now, I will just drag that over. Yeah, so on the hourly chart, this was yesterday's price action, rallied up, engineered some smooth lows, and then worked its way lower into the close. However, I wasn't looking to buy in this area because I like buying below old lows, and this particular old low had my attention. So yesterday I was short in this area, and as soon as we get down to this low, I wanted to see if we could use that to accumulate a long position below. So when I got to the charts, we had already gone below this, and not only had we done that, we'd also rejected from the old previous week low, which is a really, really nice signature I like to see. We go to the 15 and the 5 on the right. So now on the 15, if we look at the range from this high down to the low, we also hadn't quite reached EQ until the PM session, and then we slowly moved our way down into it. And then we've got this point of interest and that really nice clean dig into that previous week low, a really nice rejection. We then engineered this really sharp kind of impulsive low, rallied higher, consolidated, and then once again rallied higher before dropping down, accumulating, and then heading up into buy side. So on to the 5-minute chart, we can start looking at the hourly opening prices. So I see every hourly open as being fair value for that particular hour, and the same with a 4-hour hourly open. I see that as being fair value for the 4-hour candle. So what we see here is that sell side pull, that really impulsive low. We then have 2300 and midnight both opening up, being held for the most part as a premium above that level. And what I noticed is how they are both opening prices are essentially at the same level, and I see that as a original consolidation. So we are engineering discount sell side liquidity at this point. And the next thing I noticed is how below these lows, if this is a consolidation, then you can essentially see this as a kind of like smooth lows. And below the smooth lows, we've got that really sharp low. So this is a model framework that I use called the Delirium framework, where we've got a impulse low with relative equal lows above it. And the framework essentially says to target that low, but my thinking behind it is pretty much that you have this false support level. Anyone who's looking to buy at this support, they're probably going, okay, I'm going to buy in this, this zone, and they're not going to put their stop loss right below the zone. Well, they might, but the ones who think they're smart are going to go, okay, this is my support, and I'll put my stop loss just a bit below at this area down here. And so my logic is that there's going to be a large amount of liquidity built up below this swing low, simply because of that dynamic. Then we have 1 a.m. open up, goes directly to a premium, so it's enticing longs at a premium of this range, engineering more sell side below all these lows. 2 a.m. opens up and immediately sells off, so that's to a discount below the 2 a.m. price. So for the 4-hour candle, we're now at a discount. We begin digging into the sell side, slowing down a bit. Possibly there's more people getting long in this area. And then 3 a.m. once again remains at a discount for the most part, and then eventually sells off nicely into our point of interest, which is this old low from back here. And now another point of interest is going to be this swing low. So I'm going to draw that out and just make it dashed. So that's that 15-minute swing low. Now this brings me to where I was looking to enter. I was watching the 1 minute and the 15-second chart as we dropped into this area, and I was especially interested as we hit this low, this impulse low, and just watching price. So that's how I caught that long in this area. And then it continues. But I'm now going to have a comparison of these two time frames. So the 15 minutes. Obviously, we're dropping nicely below this swing low. You can see us having multiple stabs down there before eventually taking off. What kind of put me off a bit is simply how 3:45 a.m. and then the 4 a.m. candle essentially make relative equal lows. You're overlapping the majority of that wick with the 4 a.m. candle, and most of the time you want to see an hourly candle take out the previous hourly candle low, which 4 a.m. does not do in this case. So that threw me off a bit, for sure. And I was extremely, as I said, I literally had like a 8.5 out of 10 conviction level on this trade, which is extremely high. Like I was very confident that we were accumulating down here and that we'd run higher. And I did also know that there could be, this type of price action where it's a little bit more consolidatory looking, if that's even a word. But at the same time, the 4 a.m. not taking out the 3 a.m. low, it did kind of throw me off. So on the 15 minute, you can see that order block does end up holding. It sends us higher, but once again, more relative equal lows in this area as well, therefore ripping higher. Then on the 5 minute, we have that run in sell side, initial low and enticement away, and then we raid that low, close with a nice long wick, trades all the way down into this wick and has a failure swing. And I recognize this failure swing on the 1 minute as being a bullish signature, but then again with all these smooth lows on the hourly and then afterwards as well, it just threw me off for sure. But on the 5 minutes, what you can really see is how this being the order block, that makes it the CSD, which means the moments that we cross that opening price right there, you expect the mean threshold to hold. So if we measure the mean threshold from the open down to the low and draw that out, you can see that was actually holding really nicely. So I can, so that's the mean threshold anyway. It's essentially just above the 4 a.m. open, but you can see the body is respecting that and then sending us away. And then after getting that second closure back above, we come down and knock nicely into that there. However, I wasn't really watching that. It's just an observation I've got now. So I'll drop down to the 1 minute, and then I'll probably bring up the 15 seconds as well. So on the 1 minute, you You can see that sell side pull engineered at 22.41, enticement higher, consolidating just above that low as liquidity builds up both down here and also below this low. Both opening prices essentially the same price, telling me that this is a original consolidation. Even 1 AM could potentially be classed into that, but I'd more be looking at these two prices. 1 AM is then held at a premium. This often happens when they are enticing away from a pull to then come and accumulate. So you can see the same thing happening probably on the downside. I won't try and find an example, but yeah, 2 AM opens up, immediately sells off to a discount. So we're at a discount to the 2 AM open. And if you're expecting like a 4-hour candle, below is discount, above is premium. So we're dropping lower. 3 AM, the exact same scenario. We just drop to a discount and drop really nicely and aggressively down to this low. So after hitting that low, we make a 3-drive looking pattern right here, and I was watching that as well, so I was extremely confident with this 15-second long, and it was a very good trade. It just turns out we came down one more time to take out that low, and yeah, that could have not happened, but also it does make sense for it to happen, where by engineering this first low, suckers like me are going to chase it, and then it comes down, does the actual job, and then they make it quite ugly. It's not so clearly a reversal anymore. But that's why I'm doing this, so I can identify what actually stands out that makes it a reversal. If we zoom in a bit, if we look at the dealing range from this high down to the low, see we essentially come up to EQ of the range right here, and then sell off even lower. So I would say, because we actually do close above the midpoint of the dealing range from this high to the low, I'd actually call that a return to equilibrium, meaning this is a new low and this becomes an intermediate term high. So when we break that intermediate term high, that could essentially be the confirmation of reversal. The facts also that this high does not get taken out by this high here means that this entire range from here down to the low and across is very well balanced. We've been painting backwards and forwards all throughout this range, meaning that the moment we break out the range, you'd expect the midpoint here to remain intact. But back to this area, as you can see, that impulse high, this short-term high, the premium, as soon as we hit that, really nice sharp projection, runs up into it once more and sells off. So I was watching out for that, and which is why I took the partial there, and that went really nice. If the next candle had then run up and closed back up in this area, I would have added back onto the position, but that didn't happen. And then we have this area here. So in this area, we take out the sell side once again. We have multiple digs into it, and then it just consolidates quite a bit. Has a lot of backwards and forwards movement. And I found this point quite interesting. A new 5-minute candle, also the 4 AM open. It rallies up, takes out this buy side pull, and rejects aggressively. So usually if you were bearish and you saw this, you'd want this high to remain intact. You would not want to see this come undone. Meaning that once we get back above it, you can look at this kind of range, and it's easier to see on the 15 second, but this range as being a breaker block or of a sort. So drop to the 15 seconds that you can see a bit more granular detail. Because I've been watching the 15 second a lot this week on both NASDAQ and gold, and yeah, it looks, you can see a lot more in this area on the 15 seconds. Let's see if I can fit both of these in nicely. So back to this area, this is where I went long the first time. We have a nice swing high just here. It got long right there, and then took profit up there with stop loss down below the low, and then got stopped to break even. Takes out the low. We don't have any swing highs within this range, so I wasn't taking any longs just yet. I was wanting to see a swing high on the left side of the curve broken. We then get this sort of a market maker sell model looking thing, and as you can see, high low, high high, and then aggressive drop down with that 4 a.m. opening. And then it just works its way into a deep discount of the range, really high resistance, before aggressively running back out. Now at this point, you can more clearly on this time frame see that what you'd call a breaker block, or a inverse breaker block really. I mean, it's a breaker block either way, but mostly we run out that buy side pull and reject aggressively, and then after doing that get back above. So that's what makes it really stand out to me, and as you can see, that held really nicely. But apart from that, what we now have is a 1 minute swing high, being this high here. And if I draw that out, what I usually want to see is after we get back above it, so we trade above it, retrace, trade back above it again, I want to see this the retracement leg remain intact. And that goes back to the like a breaker block in general, is even if we're traded below it, once we get back above it, that's when you want to see it remain intact, and that happens with any mitigation block on the left side of the curve as well. But kind of beside the point, as you can see, that does play out here. We trade above it, back below, back above, and then after getting back above, this low does not get taken out at all, but we do come really, really close. As I mentioned, I got long in this area here, got stopped out because I have my stop loss sitting inside of this gap, wanting to see it remain unfilled due to the fact that we have this consolidation in here. But it does come and nick me out, run back up. I got long using the 15 seconds chart in this area, or the 1 minute, not sure, but that runs up into the highs, taps this buy side pull right there, and once again rejects again. So I was anticipating that could be the case because I'd seen it happen over here, and it's sold off, stopped me out at break even. Now this gets to the bit where I saw I could have actually had a really clean entry, and I think this would have been the way to play this. The fact we made equal highs, so I'm going to make this like that. These equal highs and this consolidation, traders will typically see that as resistance. So they think, cool, this is strong resistance. We just tapped it twice and had the strong rejection back down. So as soon as we tap it, we reject lower, and I see this as enticing shorts from relative equal highs. So everyone sees this as a really strong zone, and price can't get through it. It's selling off, and now it starts consolidating at a discount of this range from this high to this low. And as we consolidate, everyone's just seen the narrative that was pushed, that this is strong resistance, and it's rejected. So everyone in this area is theoretically shorting. Now, if everyone's shorting in here, this is a great place for smart money to accumulate their position. Still below that 15-minute impulse low, below this old low as well from the Wednesday, I believe, from back here, that 15-minute impulse low, and below all of this sell side as well. Also, as I mentioned, from this high down to this low, we are basically sitting at a bit of a discount. So a really, really nice area to accumulate. As you can see with the 4 a.m. price, we spent a bit of time below it initially, and then 407 rallied back above. And that kind of threw me off a bit, the fact that we were now above the 4 a.m. price, and the fact that 4 a.m. did not take out 3 a.m. low. But we're already at such a deep discount. I think when it's a reversal and we're already clearly accumulating, making higher lows isn't necessarily a bad thing. It can actually be a signature of accumulation. So after an enticing lower from this resistance level, we then consolidate, giving time for everyone to chase the short from resistance as smart money accumulates and buys in this area. And now traders are trapped short. We get an aggressive move back out, so displacement. That shows that whoever's short in this area, they're now trapped short. And if we've got trapped shorts down here, we don't want to see price return all the way down into this area and let traders out of their position. So that's where the narrative comes in handy, that we can say, okay, we've trapped them down here, we've then displaced back out. I now expect this area to remain mostly unfilled, and definitely don't want to see us come below the midpoint of this consolidation. We then break out above the relative equal highs, and then you can see how we could have played this. So obviously after displacing back up, we could have got long in this area, but then we then break out above this high, pull back aggressively into the range. So obviously we've also got breakout traders getting long above the highs and buy side, but by doing this, we're likely knocking them out. And now if we look back in this range, in this leg, where do we have an impulse low? So an impulse low is oftentimes going to be the ideal soup candidate. We can refer to this 1 minute impulse low. So after hitting the highs, we aggressively sell off. We hit a impulse low. After hitting the impulse low, do we continue pushing down below it? Nope, it just has one dig below it, then another quick soup, and then rejects higher. So we've clearly rejected this impulse low, rejected back into the range. And now we can look for a market structure shift within here, which we have one right there. Market structure shift, and then you can buy as soon as we start pushing back above that. With a really tight stop as well, like I would have done this. That's the trade, and then obviously that becomes 100R today. That would have been the ultimate. Also anticipating that this would be a soup, I could have done that, knowing that, okay, well, if my narrative is that we just entice traders from these smooth highs, traps them short in this consolidation, and then displaced away from it, we are not going to retrace really deep down here. And if we do, then I'm just completely wrong. So I could have anticipated this to be a soup of this impulse low. I could have simply bought here like that and just put the stop below, I suppose probably just below the actual imbalances of this range. Sure, I could say from this high, well actually if you look at this, from this high down to this low is a single run. We then consolidate within that range all the way until we break out here. So this is a very well balanced range. Definitely don't want to go below the midpoint. And these aren't real fair value gaps because it is within a range. So it is, as soon as we get out of that range, this is entirely balanced, which is why you see such nice support there. So I could have obviously put my stop, right there quite easily. Yeah. The only problem is that a lot of the time I'll try something like this on gold and I would have just missed something that I didn't see. And in hindsight, you can always see, oh, well, that's why. But a lot of the time I might see this and I'll think, oh, cool, so I can just put my stop here. And then it turns out I missed something about, maybe we spiked out of the range at one point and it didn't actually fit the criteria that I had for it. So it might make more sense to actually give myself a bit more margin for error, especially in a high confidence, high conviction trade idea. But I could have bought that suit, and then obviously getting this entry right there, that is the ideal entry after that shift, and then we get back above it, that's the entry. Then we start just pushing up really nicely throughout this area on the 15 and the 1. This could have been an entry, and I'll quickly mention why. If we go to the 15 minutes, could have been an entry as in I need to backtest it and understand how it works a bit better. But if we look back on the 15 minutes, where's the first, I suppose that could be an impulse low, but I was looking more at this, really obvious swing low that ran higher. We draw that out. You can see that we tapped that really nicely. Obviously, you'd be expecting a inversion fair value gap in this area, which you could refer to that low on a high time frame inversion fair value gap. So as soon as we push up through this range and get this closure up here, you're expecting this to hold price, this area. Also, the fact that we just had a breakout above relative equal highs, we already pulled back into the range and now we're breaking out a second time. You actually don't want to see it retest this area. So I could have definitely been watching attentively in this area for a potential entry. Price back. So let's say I was watching the 15 seconds in this area. I'd probably just be wanting to see us take out any kind of short-term low, such as that one right there. And then once we get this nice rejection back up, I suppose just buy it on the way up. Or higher confidence could have just been, just buy it in this area and just trust that we don't come back super deep. I don't know. You can kind of see the market maker framework right here though. Original consolidation, first stage of the model with a intermediate term low put in, then short-term low to the right of it, and then we've got IOFED, which then sends us up into buy sides, where we begin to reaccumulate with this consolidation, which you can see with 5 and 6 a.m. same price. Original consolidation, expansion, consolidation retest at mean threshold of this consolidation range, respecting that nicely. So consolidation, retest. We then have first stage of the market maker model, consolidation with short-term low, intermediate term low, short-term low, pushes out, breaks the high, confirms first stages are played out. What's after first stage? Second stage, which is where you're looking for volatility. What's happening at 8:30? NFP. So this is a beautiful example of price and time meeting really nicely, where we have a clear market maker model, consolidation, retest, first stage of the model, breaks the high, second stage just happens to happen at 8:30, and that's where you're expecting volatility. So and I was watching this area, but I wasn't taking a trade simply because I missed it down here. It was almost NFP, and I just wasn't. I was more observing to see if NFP offered a opportunity to enter, but it actually ended up just distributing. But it's really cool to see that it actually played out exactly. And if I go back to the 15-minute chart, I'll bring back that new day opening gap. There you go. So what I like to see with these is if I'm looking, so that's from this previous day low that we rated. We rated this previous day low. That is the daily opening candle for this low that we just rated. And now we have got back above it after accumulating. So in this area here, sure, we get back above it, but we haven't reaccumulated down here yet. But once you have the narrative that we've clearly accumulated, and now we're once again back above that new day opening gap from the day that we rated, that's where you can look for it to act as support. And that works really, really nicely right here. Just happens to line up perfect with NFP as well, which is beautiful. So in summary, really clean trade, really clean read on price. It couldn't have been much cleaner. What I need to remember is if we're clearly in an area where we're accumulating price, I need to not be too worried about leaving sort of smooth lows as we accumulate. I think if I spend more time watching just order blocks being respected on the 5 and 15 minute charts, then I'll be able to see, okay, cool, we've rejected this order block multiple times just there. Also, we keep on dipping and referring back to this key liquidity pool. So just the fact that we keep on dropping below it multiple times and rejecting each time we do, that should be a signature that tells me that I'm on the right track. And if I go to the 5 minute chart as well, I should be watching these opening prices and trying to read order flow by looking at the CSD. Are we respecting that? Okay. Are we respecting the mean threshold? Yes, we are. And really just looking at the closures. As far as all these lows go, that threw me off a bit. But if I'm unsure to that extent, for one, I can be using a high time frame stop loss. However, with my most recent entry model, I've decided that it actually makes more sense to miss trades and to have 5 times the amount of size on for trades that I win, than just to buy here with stop loss way down here. But I could have done that as well. In this area, a really good play with catching this long that worked out really nicely. I really liked how I could watch us come into this range in the 15-second chart and catch that long. However, then once we hit this high, also taking that off, that was really, really well played. Adding it back on if we closed back above, which we didn't right then. We only did, if we refer back to this exact same high, we draw it across, we did actually close back above it over here. I don't know exactly how I would have played that, because obviously I don't, you don't want to put a stop loss all the way down here. But there might be something to that as well, still referring to that same high, despite the fact we made a low low. I was actually more watching this swing high, which is the most recent 1 minute swing high before making this low. And drawing that out, we also, get back above it over there as well. But I think in this situation, really reading the narrative of who's trapped at what point and why should price not go all the way down into this area and continue high. That would have given me the confidence to see, okay, smooth highs, we just entice shorts, trap shorts down here, and now we're heading back up. That would have given me a beautiful long opportunity. And going back to the 15-second charts, just to recap that really briefly. That 4 a.m. taking out the buy side, dropping lower, and then getting back above, indicating a likely shift. That pullback actually never got taken out again. We then make that smooth highs, trap shorts in this area. We've got from this high to this low, remain in that range, making it all balanced. Breaking out above the smooth highs, aggressive drop back into the range to take out any breakout longs. Anticipating this to be a super long, also anticipating us to leave this area unfilled. We get exactly that, and then that's your entry. And then as we push up, some nice distribution. As far as this area up here goes, if I were to have entered it, I wasn't entirely sure how deep into this area it would reach, like if it would reach very far down. I suppose I could have potentially looked at some impulse lows from this leg for a old low to buy below. On 5 minutes, it doesn't reach down to there at all. We leave this gap entirely unfilled, but that lines up with this balanced range on the left as well, so that, I suppose, explains it. The thing that jumps out at me is this swing low from this impulse leg that made the high on the 1 minute. If we draw that out, after breaking out above this, it comes down into it, also down into original consolidation as well. Then we get that first stage of the market maker model, short-term low, then intermediate term low, short term low, and runs high. And if we look at this range in here, and first of all, that's the most recent swing high. Runs above it once, runs back below, begins consolidating quite a bit down here, comes to a deep discount. So this is just ahead of the news. It is beginning to, it's just consolidating all the way down here, but I suppose you could refer back to this old low, potentially. Trying to figure out how I would have got positioned in here with the highest confidence. I think anticipating this to be a short-term low, so recognizing that this is a short-term low here, we're then taking that out, making an intermediate term low, making this first stage of the market making model displacement. Now I'm anticipating this low to remain intact. So if I'm anticipating this low, I'm looking for this to be a failure swing. So we make a low here, reject high really nicely. However, when we do that, we don't have any shift at this point. And I'll have a look at the 15 seconds, see how that looks in this area as well. I think that's where we are. There we go. So if I'm anticipating this to be a failure swing, I don't want to see it take out this low. How low is it going to go? So it runs lower. Runs up above this high. Sells off again, makes some smooth lows down here. Honestly, it doesn't look super clean, and I suppose it is, quite the consolidation. But I would have looked at this short-term high right there, seen us have a run above it multiple times. However, we've failed to take out that high. Sells off again. Runs higher. Aggressively sells off again. And at this point, runs above the high, pulls back below it, and then closes back above this short-term high. And then back up above this high, which is that 1 minute swing high. So this is really the 1 minute swing high that made the low. Then after getting back above that, it just keeps on pushing higher really. So with my failure swing model, how it typically works is if I'm expecting a failure swing, I see that as confirms to be put in after we disrespect a premium array, which in this case would have been once we closed at a premium end of this breakaway gap. Then that is disrespecting those arrays. There are no imbalances down here because it's very well balanced. We also have a bit of an immediate rebalance with this drop down as well. So that's also a signature of speed. So once we get at that, hitting this high, an immediate rebalance, and then rip right back up, that could have been a clear indication as that's a good place to accumulate the position. You could also look at this old low, draw that out. Sorry about all the lines, too many lines right now, I'll delete a few of them. So this old low, an impulse low that entices longs, accumulators below it. We then souped an old low below this old low, rallied back above, and then that order block now holds really nicely. And then you could also see this entire run lower as that same sell side delivery price leg. Kind of similar to what we see over here, where we have this old low, we run below it, get back above, and then we're looking for support in this area. And then in this area was probably the highest probability. We're just seeing a really clear regional consolidation, a really clear first stage of the market maker model, and now we were back above this area here. I don't know if I would have entered right before NFP or not. but clearly it worked out really nicely. Maybe with futures it could have been a really good play. And as far as stop loss goes, I suppose you would have had to allow for it to drop back into this range, this previous area of accumulation, but you wouldn't want to see it take out this order block. So you could put your stop all the way down there, I guess. And yeah, but ideally you bought down here and then trusted the narrative and the draw and liquidity, which is really obvious. There's going back to this area in here where we have relative equal highs, trap shorts, breakaway gap. We don't want to see it drop into this range. I'm going to bring up a similar but short example of the same sort of idea from, I believe it was yesterday even. Yeah, here we go. So relative equal lows is actually a delirium framework, one that I traded and worked really nicely. But relative equal lows, a impulse low just below it. So we know that whoever's buying in this area have their stop down there, so wants to target that. But a smooth lows entices longs, does a bull flag. Retail traders will be buying in this area. Smart money is shorting in this area. Aggressive drop lower. We now have trapped traders in this area. Their stop loss is down here. And so we're not going to pull all the way back up into this area. We can trust that this area should remain unfilled. We can look at a inversion fair value gap as well, which is what I use for the short. But just anticipating that it should not get up into this area because we have trapped longs up here. Same thing over here. Enticement from smooth highs lower. Traps traders at this discount the range. Aggressive move out. Anticipating that we will not let them out of their trade. So in this situation, where is everyone stops? Well, if we look to the left, where is the most obvious swing high? Well, jumps right to this one, and then also this one up here. So that's the equivalent to this swing low down here as well. Yeah, back across to executions. So yeah, really nice trade this one. I meant to put on 20, but I had my hotkey set to NASDAQ up here instead of gold, and so I accidentally went long NASDAQ instead and had to cancel that and then put on 10 twice here instead. But that worked out nicely. It was good to go to break even as well. Then drops lower. In this area here, rather than being too fast with getting long here and putting a tight stop, I should have allowed for it to have a bit of a pullback into this gap. And then when it started trading out, that was good long for sure. But just the fact we spent so much time in here showed that we were accumulating and dropping back down. So that should have just got me more switched on to seeing, okay, what is the narrative? Who is selling right now and why are they selling? Well, retail is selling because we have this resistance level that price can't break through. And so retail is selling. We're at a discount. Retail is selling at a discount now. We then have an aggressive move away. So now I have all the narrative of us accumulating in this range that retail traders are selling at a discount of this range from this after the enticement from this resistance level. And so now I can trust getting long in this area for the breakout after we'd already poked above those highs, rejected, and then catching this run up. Now to briefly go over NASDAQ before going to bed. So I don't want to make this take too long. But I'll do very brief top-down sort of thing. I'll just point out my point of interest basically. So we could tell we're about to sell off by the way that ES, which was showing the strength, was beginning to flip over as Nasdaq started showing strength right in this area here, and ES started showing weakness. Also the fact that from this moment onwards, we were not showing crisp bullish order flow. We were closing in majority of gaps, trading past them point of wicks, not respecting order blocks cleanly, and it was just beginning to become high resistance. So from this area right here, I was already anticipating that we were likely to come lower just by the way that the order flow in the high time frame was slowing down. Smooth lows down here, and if we drop to the 4 hour, we can see a point of interest that I've had on the charts for a long time on a different layout, and that is this 4 hour bullish order block. So if I draw that out, you can see we just fell short of that today, which is perfect. Means that Monday, when we're expecting a bullish week, I think 70% of the time Monday makes the low of week. Might even be higher than that, but I'm not sure, but it's a really high percentage of the time Monday makes the low of week on a bullish week. As you can see, that's sitting really nicely below these relative equal daily lows. So we have engineered liquidity just above a key untapped bullish order block. So really high confidence for this being at least a draw and likely a reversal point. But yeah, knowing that we're likely to sell off towards that, can you get rid of these lines real quick? And I've dropped to the 1 hour. Let's see where we opened the day today. Right here at 1800. So that's the new day opening gap. So we opened up, rolls over directly out overnight. That's after we had this situation. This was a earnings, I think, for something. I think Meta, really nice big rally. The next day just sells off beautifully throughout the day. And then today opening up, remaining extremely heavy below these lows and just continuing to push lower really aggressively. Down into this area. So this is where we've got NFP. Now what I noticed as we headed into NFP, I'm going back to the electronic. So as we headed into NFP, we had a really obvious low down here. RTY was sitting just above a really key level, the 80s I believe. We had ES. At NFP, ES had a perfect retest of its 50s level. If I bring up ES real quick, you can see on the 300, sorry. So NFP perfectly retested the 300s. So it was indicating that we were creating this false support here after this big sell-off. So everyone's thinking we're overextended and they all want to buy this support level. Obviously, there's also a really long hourly wick down here. And I find those are beautiful draws in liquidity because people will typically look at that as a strong bullish rejection, means there's heaps of buyers down here. And so, you know, price is going to reject price, and that's exactly where price goes to. So the next thing I was looking at was how we didn't have any SMT on price at this time. It's 8:30 AM. There was no SMT. If we bring up ES, they both looked relatively similar at this point. And the most obvious high that I could see that we could take out to put in SMT was the 4 AM high. And as you can see, ES did in fact take that out during the AM session, and Nasdaq failed to do so. So that gave me my SMT for the short in this area, which I will get to. The next thing is, because I was anticipating we would likely do we could do a Judas on buy side before going lower. So I was bearish on the day, but I anticipated that, well, we don't have SMT yet. We have fairly smooth highs up here and the news high obviously as well. And it would make sense for us to do a Judas high before going lower. So I wanted to see, does it show me it wants to go higher? Sure enough, we get this SMT on the lows at 834. It's a really nice SMT. We then head higher, get this nice market structure shift. And this is a nice long that I caught. So I've got to shift the market structure just here. And I got long like that with a stop loss below the order block. So long was the order block, stop loss below, anticipating that to be a breakaway. And that worked out beautifully. Took partials at the 50s, and then I was watching in here for SMR. I saw how we had hit that the 4 a.m. high, and so if I dropped to the 15 seconds, I was watching that to try and find an entry. Now, I've been very focused on one particular entry technique this week that I've been working on, and I was specifically looking for that this morning. So it didn't show up cleanly, and because of that, I didn't catch the initial move. And yeah, in hindsight, you can, we ran out these highs and then it rejects lower. So that should have, I was hoping to get short up here basically. That didn't happen. We just spaced lower. I thought, okay, well, it's doing exactly what I wanted. We've got that SMT on the highs. It's rejecting lower. But at the same time, I was still wanting to see that particular entry model. And so I was watching this area thinking, okay, can I find it? So I was probably watching the 5-second chart as well. But just trying to find that entry model. We then get this beautiful inversion gap that I was looking at. And I was thinking, okay, well, this would be a great short. But let me just see if I can, catch this really tight stop loss in this model. We close below it there. I'm like, cool. Then this candle up there runs up, takes out this high. And so I was thinking, okay, this will tell me if it closes up here, then it's going back up. But if it rejects, then that's probably very bearish. And sure enough, it rejects and then immediately sells off. So this was where I did catch a trade. This could have been a perfectly good short entry right here. I could have taken that, didn't, but I did catch this next one, which worked out really nicely. So if we look at this wick, we have a long wick that ran out a short-term high, and then we get displacement after without trading into that wick. So this is the long wick plus displacement signature in price. It indicates heaviness, and when that's the case, you expect heaviness, so continuation. In keeping with that theme, that would mean that invalidation for this trade is if we undo the signature, which essentially means we trade and fill in this wick. So by putting stop loss above this wick, I was able to short at this impulse high on 15 seconds. So if I draw that out, that's a nice impulse high. I went short right there, trusting that it shouldn't get above here, and that did work out. Now, luckily at this point, I stopped thinking, okay, I have to just look for this one entry model. I actually read the narrative of what was happening in the framework and the signature and used that to find my invalidation, and the impulse highs entry points, that worked out really, really nicely. I'll look to do that more often because I've noticed when we do have any movement in price, it basically always targets at least a impulse high or low, even if it's on the 5-second before moving. Yeah, beautiful short. Sells off, got an impulse low down here. Hits that, gets a slight reaction. And then it drops to a deep discount to the range. Consolidates a bunch before grinding lower. So, yeah. Grinding lower down towards the open, and this is where I got thrown off. So I've got another framework that I was really wanting to see today, and that is based on the regular trading hour chart. Regular trading hours, when we have a gap lower, I want to see us rally up or engineer a high, entice shorts, and then target that buy side pull, which does play out, however, not until 10 a.m. where we engineer, especially in this area, some really obvious highs. This is also a really obvious high. We then entice away from it and then take it out. That would have been the actual long. But because of this, I really wanted to see if I could trade it today because I found that it's been very consistent for me in the past. And so I was very focused on it. So despite having that bearish draw and wanting to target this this order block in the sell side down here, I was right from the open wanting to go long. And part of the reason is because I believe way back on the left, I'm not going to bring it up, but there were some old relative equal highs at about this level. So old relative equal highs. And so I had the idea in my head that, okay, well, if I'm expecting 930 to Judas, maybe 930 can run higher first, hit these old relative equal highs, take out this buy side pull, and then sell off from there, and then I'd go short. And so I was really hoping to see it would run up at the open, but we didn't. Instead, we engineer a high, drop a little bit lower, immediately take it out, and then reject really hard. So straight away, that should have told me, okay, it's ready to go lower. It doesn't want to go high first. We've also got SMT right away with ES, which is dropping low and quite heavy. And it makes sense why, because we had this perfect retest of the 300s level down here. And price just wanted to melt down through that, which I was expecting. And we'd already enticed away from it. So it didn't really make sense as to why we'd need to do that again, which we already did. So we had this big enticement away from this support level over here. Then just before the open, we do the exact same thing on a smaller scale. So when we do break through it and just fail to retest, that should be a sign that, okay, it wants to go lower. Which I did know. I knew all the stuff. I knew that we're probably just going to keep on grinding lower. But, I mean, I'm on demo and practice accounts at the moment. And so I was just zoomed in thinking, okay, well, let's see if I can identify this this reversal model, and then I'll jump in as soon as I get it. And where I went wrong today was also using the 5-second chart, which I've figured is not worth using, simply because sure, it can give me more detail, and sure, I might be able to catch a long right here using the 5-second chart, but then it rips in just a few seconds and then taps a high and reverses on you. So if I'm trying to catch a high time frame long on a 5-second chart, the model might play out perfectly and it rallies, but then 10 seconds later, it didn't hit your TP, you didn't move your stop, and now you've taken a loss. So the 5-second chart doesn't work. 15 is really nice. I do like using that. But you can see in here how, yeah, just sells off essentially. And so I want to have a quick look through this range, identify what shorts were available for me and how I could have taken them. So straight away, soup out the 930 high, reject low aggressively. There should be a sign that, okay, I look for this to remain heavy. We then get this big green candle, enticing longs, and then a bit of time up there. We tap this short-term impulse high, reject it, and then aggressively drop back down. So that should have told me that, okay, we've rejected a high. So the high's been rejected, check. We've got an impulse low down here. Yep, we've got the narrative behind it that we just enticed longs. Cool, so I can trust this low for a short. Potentially could have got short right here on the closure of that candle. That would have been a good short. We then keep on pushing lower, just grinding. There isn't really too much happening right here that we can see. Yeah, so next up, if we look at this area, what I liked in here is how we have this really long wick that made smooth highs. This long wick indicates that they're creating the narrative of this being a bearish rejection, and whoever sees that as being bearish is going to want to put their stops in this area. Then on the 5-minute chart, if we jump over there real quick, you can see we also got this really long wick on the 5-minute chart. And so we then had a 1 minute long wick, a 5 minute long wick, both suggesting that whoever's chasing this drop lower has their stop loss sitting in this area. So that was the first signature. And so when we started climbing back up, I caught a long on the 15-second chart and it failed to reach my TP and came back down. At that point, I walked away from the chart for a bit, just before this beautiful reversal. But that's the narrative you're looking for, that long wick on the 5 minute on multiple time frames, indicating that we've just been encouraging people to put their stops above these highs. We then make relative equal highs with another long 5 minute wick and then sell off at 10 a.m, dropping really aggressively low. And before coming back up. Now on the 1 minute charts, there was a beautiful entry here. Obviously, we've got this nice inversion fair value gap. But other than that, we have this run up there, we have another run up there, and then this aggressive push up through. And if we look back to the first 1 minute swing high, we find that one. You can find that we got above it really nicely here. And I caught this long of a nice tight stop loss. That worked out really nicely. Bit of an original consolidation as well. Now this is where it gets kind of interesting, is that equal opening prices on the hourly chart is one signature of where original consolidation is. Another one is that original consolidations tends to happen at institutional price levels, such as the 900s. So the 900s here, we then consolidate at that price. That was the entry long, and then coming down to test that, and we didn't take out that swing low again, which is beautiful. And after this original consolidation, what really gave me this narrative was when we got this area here, a clear short-term low, intermediate term low, short-term low. So now I've got consolidation, first stage. After first stage, we're looking for second stage, which is here. Second stage sends us up. And so at this point, I'm thinking, okay, I can see a clear left side of the curve. We're now showing very high resistance order flow. And so it would make sense if we are going to come back down, because we haven't met our draw yet, and also the low of day so far is at exactly 800, so very, very suspect low. So I was looking for a short up in this area. Now, if we draw out this, and we can look at the big picture, see what actually happens. We engineered smooth highs, enticed lower, and then ran it out here, including this high. So this eye really stood out to me as a really obvious buy side pull. So I didn't really want to go short below it, but I did get a signal entry right here on the 15-second chart. I took it, it moved a little bit, and then stopped me out. And I'll dive into it real quick just to see what it looks like. So this swing low, worked up above it, displaced below. I got short right here, and then it comes all the way back up once again. I think maybe with these kinds of reversals, waiting for, rather than a wick, waiting for an actual closure might actually be the high confluence situation. On the 1 minute time frame, this was the swing low you'd be looking at. We wick below it, we then close below it, run it back above, get back below. Potential short, but really wide stop loss, that's a problem. But I liked how we now had a potential reversal, a short-term high, intermediate-term high, and this aggressive rejection from this buy-side pull back down. And so at this point, I figured, okay, this the same as the situation that I mentioned from over here, rejecting this high, breaking this low. Same here, rejecting this high, breaking this low. So that became a short entry, which came up, made smooth highs, but still continued to sell off and then it's got really high resistance. And I found, because I was watching the 5-second and the 15-second chart, in this area here, if we zoom out and see what it looks like, I was watching it like this, as if it was a really nice range. Okay, what's going to happen next? Really stretching it out, failing to realize that this is the shittiest time of day ever to trade. Sure enough, just shops around, taps that original consolidation just for reversing back up. That's cool. You can see the market maker model here. You can see first stage of the intermediate term high, and then second stage of the market maker model before sweeping out the low once again. That was a short entry, but I should have been very cautious in this area, and that part of the thing that should have made me very cautious is obviously something like this can happen. But also, if we look at this is a range where if this was to hold and hold price below it, we would not have closed past the midpoint. Right there, we closed above the midpoint. So that's telling you instantly that, okay, this is essentially making relative equal highs. That's what that's doing. That's relative equal highs right there because we disrespected the premium array but failed to take out the high and sold off. So this is a retracement to go higher. This is now the 10 a.m. candle high. We closed the 10 a.m. candle here. So on the 1 hour chart, we have a really long wick. Whoever's chased the short down now sees a nice long wick on the 1 hour chart. They put the stop loss there. 11 a.m. opens up. A lot of time at a discount before at around 11:35. We rally back up aggressively towards the 10 a.m. high. Failed to take it out, so now we've got hourly relative equal highs just below that key buy side pull. We then run above it with 1, 2, 3 drives during the 12 a.m. time. That third drive occurring at 12:26 p.m. and then having this nice displacement lower. So this would have been the short entry. Just looking at this swing low, look for that market structure shift, and then getting short in here. So yeah, a lot of potential there. And what's cool about this as well is from this low to the high, where is the discount sell side pull? If we look for a discount, that's not discount. There are no pulls down here. That is the discount sell side pull. And sure enough, we drop really aggressively down to that 10 a.m. price and then just continue digging lower. It would have also been some nice opportunity in here for a short, for sure. And that would have just been because this range is balanced. This range is also balanced. We then break below that. So we're not expecting this SIBI to get filled. This isn't a SIBI. This one should remain unfilled. And so you could short right there above that swing high with a stop loss in there. Selling off really nicely into the range. And yeah, and so on. And obviously leaving this for Monday, I'd say. If we go to the 15-second real quick, and I'll go to the 5 minutes on the right just to haven't really looked at the 5 minute that much. Nothing really stands out to me, really. This here, this very long wick that was not followed with displacement is an indication that we're likely to run this high out, as we do. If this had happened and then we left a fair value gap right afterwards, I'd expect it to just keep on dumping. But when we get a really long wick to either side, and then it just hovers next to it and doesn't get away from it, then that's going to get targeted. The same down here, if this wick had been formed, and then rather than displacing, we just continued consolidating here, then I'm expecting it to just melt straight back down. Kind of like what we see here, a long wick and now just consolidating. Don't know if there's another nearby example, like this one here. It's a really nice example. A long wick that we don't go into, but we also do not displace high. It just consolidates sideways, 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 and then just melts into that low. Everyone sees this as a strong bullish rejection, and then a bull flag, whatever. Everyone buys and it sells off. Whereas in a case like this, long wick plus a fair value gap means it's going to be a nice big run up. That's beside the point, but let's see where we're at. So how I would have played today. Really liked that 1 minute long this morning on just after NFP. That was beautiful. I also had the perfect narrative for the short with the SMT on the highs, ES with that clean low, the lower draw and liquidity. So rather than getting so focused on this area here, if my entry model shows itself and I catch it, that's great. Not using the 5-second chart. But yeah, that'd be beautiful. But then as soon as it sells off and we get this alternative entry model, which I was just so focused on the model I was wanting to see that I actually ignored. Well, I didn't ignore it. I saw it, and I just did not feel prepared to take it, even on my demo account. But I was observing this, and in future, because I had such a clean narrative, it's perfectly fine to take an A+ trade, even if it's not the exact model you thought you'd want to see. But that would have been a great short, trusting with traps longs above the highs, and that this BPR should be respected, especially after we get this rejection there. I did a really good job with jumping on board in this area here. If we look at the 1 minute swing low as well, which is all the way over here, this could have also been an entry. And I suppose I would have just waited for this retest of that low. That would have been the good entry right there. So not worrying too much about this, not chasing it, just waiting for it to come back. And then just using this bearish order block that took out the swing high on the 15-second chart as the bearish order block. That would have been a great trade as well. So first of all, look for entry model, but don't worry if it doesn't show up immediately. But I really like this rejection from there as well. Beautiful push low. That was a beautiful short in here, in this area. And yeah, then adding there was a really, really nice trade. I really liked how I was able to use the impulse high as my entry and use the signature as invalidation. That was the entry right there. Not worrying about it displacing away from where I wanted to enter initially, but just trusting the fact that, okay, now we've got this high to low. If we look at this range, this dealing range, we failed to retest EQ right there, indicating that we're engineering a internal range liquidity setup, IRL setup, eventually hitting that there. Spending a bunch of time up there before aggressively rejecting lower. Engineering some internal range liquidity before drifting down into the open. The open doing its thing, but as soon as I see it run, rejects this high, even though I think it's coming up here. Like I thought, okay, it's going to come up there, then go lower. When it does this and rejects aggressively lower, at the same time, ES is breaking out below the 300s after having multiple enticing rallies away from it and aggressively dropping down with SMT on the highs. They're telling me it is a short, go short. I can sit through this stuff, not worry about it. There's nothing to do there just yet. But then what I'm watching for is for us to fail to get back above a short-term high and to reject it aggressively, such as we do right here. We go above this short-term high and we don't keep on pushing, we reject aggressively. Tying that in with the narrative of the bullish up-closing candle, enticing longs, I can then go back to the 15-second and confidently get in down here, trusting that we will remain below the midpoint of this range, and I can also use my tighter entry models to get short in this area. just continuously selling off. I also really like how I was able to build the narrative with these long wicks in the 5 minute and on the 1 minute chart into my regular trading hour trailed stops framework, which I was looking for a long using. However, just because there are wicks doesn't mean get long immediately. You want to see wicks and then enticement away from those wicks. So here you can see that we got this long wick, and then the 5 minute put in a long wick, and then another one and a failure swing, leaving smooth highs, and then an aggressive push away from that. That's where you're thinking, okay, now I'm really interested in a long. However, when we're just engineering liquidity, that's not when you're interested. It's the same back of that 5 minute example of that long wick, and then all the consolidations after that never took out that wick low. You were not looking for a long wick to engineer and then immediately go short on the very next candle. You're waiting for it to build a narrative and build 1, 2, a bunch of candles like this after making that long wick. And then at this point, you're like, okay, they've had plenty of time to get long, and then maybe price spikes up a little bit, entices longs once again, and then begins slamming down, then you can trust the short. But you don't want to just get short as soon as something engineers. The same situation here. A long wick engineered. I don't want to get long just straight away because, oh yeah, I'm looking for a long and now they're trapped shorts. No, it's entice the shorts, set the stage for that to be the case. And then when we get that additional enticement away, that's where I'll be like, okay, this looks really good. Also, when there is no pre-existing liquidity at a key price level, such as the 800s or a key institutional level, even if it was relative equal lows, let's say we had perfect equal lows here, and it wasn't a price level, but if we had perfect equal lows, if they were perfect equal lows, but it was really, really, really old, and probably no one was looking at it, then a lot of the time you can see a perfect retest on the initial test of it. And because there was nothing over to the left for miles, the fact that we rejected the 800s is actually a confluence for that being a intermediate term low. So we get that nice push away. On the 15-second chart, we get a really nice strong displacement up through all these highs. This is all balanced. There's no need to return back into this range. So we're then watching this area in here. We have, I guess you could use that inversion fair value gap. But I like how we have this short-term low. If you look on the 5-second chart, you'll see that was a really nice impulse low that we hit here and reject really rapidly. Pull back, have another failure swing, and then run back up before giving us our entry up in this area here. So if we get that closure up there, dropping back down, and getting that nice long entry. So one thing that I am kind of still trying to work out is when we hit ERL, such as we do right here. So we go to internal range down here, we take out these lows, reject high, hit external range, pull back. I suppose this is where you need to look for the SBS model, like where we make a high, low, high, and then drop back into the range and take out an internal again. But I just need to be more careful when we do hit ERL to anticipate that we could pull back deeper below that initial low. And then really good job identifying the high resistance through this range, as well as the fact we're leaving perfect smooth lows behind, and anticipating that could indicate a potential reversal. Next time I should have paid more attention to the facts that we were so close to this range, as this being not a very quality short setup, meaning that even if it did sell off, it's likely to just do this and head straight back up. So that should have been something I had kept in mind. So sure, we fell short of the draw, but we're also showing indications that we're leaving smooth highs for the purpose of coming back up. And so when it starts selling off, not getting excited. It already wasn't clean up here. We're already disrespecting PD arrays quite a lot. So not getting caught up in this area either. Perfectly fine to take little scalps in here. But should not, if I identify signatures such as this, these relative highs being engineered, need to be just extra cautious with any scalps. Just take them off the table, be happy with it, be done. This rally back up, didn't catch it, wasn't planning to, but really nice. If I was watching price in this area, I love how we have these smooth highs on the hourly chart engineered. 12 a.m. does a really clean 1, 2 drives and then consolidates, and then a third drive. When we get this really nice break just ahead of 12:30, and we've got all this narrative behind us, as well as this big rally with sell side direction down here. This was the perfect time to use my model to look for that pullback and then drop back below for a beautiful short entry. And I like to look at the 15-second over in that area and see exactly how that looks. So here we do get a nice market structure shift below the swing low. So that could have been an earlier entry as well. And then as we just push lower immediately straight after that, engineering this nice impulse high, then run up, rejects that impulse high really nicely. We're already expecting heaviness. We can tell that we've clearly displaced with speed and distance below this low. Sell side is all the way down here, and we're now in this area right here. We've just had a run up, we've hit an impulse high, we've rejected aggressively, and now that we've rejected aggressively, I'm going to look back for the swing low, for that market structure shift, and then I'm going to trust it will remain heavy below that, and that would have been a beautiful short entry right there. I'd say you'd just be going short as we get that nice. So we get a few wicks below it initially. You really want to see a nice strong closure below it. And then looking for a pull back up to a reasonable location. Let's say that fair value gap. And I'd say in this particular scenario, I don't know if I'd want to do that. You could maybe. But I'd say anticipating that this should remain partially unfilled because of the narrative of us enticing longs from this area. And just the fact that we got this such strong reaction. But I mean, technically, maybe even that. But yeah, then just pushing lower slightly. Wasn't too much initially. Consolidates a bunch. Going into that 12:50 time of day. Nice rally up, an aggressive drop lower, and then just keeps on pushing lower continuously. Just trying to see if anything jumps out at me, so I'm just staring at the charts, but looks above. Yeah, and then just really slowing down over here. But that was a beautiful opportunity, and I think the trade here was really just to get short on this impulse high. As we super that impulse high, trusting that this will remain a breakaway gap, so probably put stop about there. Also note how this is 23k. So we run above 23k, because trap longs above 23k, drop below it initially, run back up, and then drop aggressively below it once again. And then fail to reach S23k back on the way through. And that could also be another confluence as to why we are very likely to hit at least the 900s and more than likely the 800s as well. 200 points below that level. Got another little model playing out right here as well, which is pretty cool to see. Seems to be the best for just plain reversals, such as that one, such as that one. Suppose you could use this one. yeah, any like actual reversal. This one doesn't really give you on this time frame. Probably 15 second has a nice model in here somewhere. However, we just displaced through this high. Then here you can see that impulse high runs above it and rejects really hard straight back down. Does initially tap it, runs up once again, gets a strong closure above, and then rejects lower. I think that could also be a key signature that suggests the reversal, and that brings me back to gold once again. Just to finish things off with a full circle, that signature I just mentioned was present on gold this morning, and I saw it yesterday multiple times as well, where we have, we have that lowest low, impulse low. We get below it once, and then we close below it a second time, and then rapidly reject back up. That made the low. If I then go back to the previous day, we have that same situation happening multiple times. Maybe a little bit harder to see, but from this low back up, this impulse high, it closes back above it and then rejects hard. I think, no, not that one, sorry. You should really be looking at this. Engineered buy side pull that made this leg lower. We already get above it, we close above it again, and then rejects really hard. And the exact same thing happens right here, where we have this swing high that made this low. We get above it, trade below it, we wick above it, and then we close back above. Now that could indicate that this low is now going to stay intact and we're going to rip up. Or if that happens and then we instantly reject the other way, that's likely a high time frame point of interest that we're not returning to until much later. So yeah, good stuff. That will do for today's review, and it was good to get some of those thoughts out of my head. I know it can be, if I apply my entry techniques to my existing frameworks, then I'll be able to make this incredibly effective, and I feel like I've unlocked leverage. For this weekend, what I really want to focus on is going over past examples of trades that I've already found and I've already done markups of. I'm going to look for these principles of market structure shifts within those trades to see how they would have played. And then also I want to go into replay mode after that, and I want to look for the specific frameworks and see how I do only applying this model to specific frameworks, because at the moment a lot of what I've been doing is applying this entry model as kind of an entry pattern. And while it's fun to do and it seems to work pretty good, unless I'm using the 5-second chart, it's not how I'm going to do this very effectively. If I want to do this effectively, if I've been given a super high powered weapon for executing trades, it's not going to do any good to just go around shooting everything that moves. It's like if you're given a super high-end fancy, sniper rifle of some kind, and then you just go and start shooting rabbits in a field of 100 rabbits everywhere, you're probably going to miss 90% of them. And what are you actually winning? Like 1 or 2 dead rabbits. Rather than that, go and hunt a mammoth or something. Go and catch the big game with a high-powered weapon, and that's how you get a really big winner, such as this. This was a beautiful trade, and I really like how I was able to nuance out why this was a beautiful entry. And I think what really stands out to me is, one, very obvious area of accumulation with these old lows being referenced, And two, the narrative of traders being enticed to go short when I know smart money wants to accumulate a long position, and that narrative being made up of these smooth highs and enticing away from them and then trapping them short down here. They're giving me that really strong confluence for this long idea. Also need to get more comfortable with just going long on the way back up. Obviously, there are things such as, I could have just used this inversion fair value gap, and maybe I should just be simply drawing out things like that. It's like I like having a deeper understanding of PD arrays and how price moves than just draw this box on your chart. Draw this order block because I say so. I like actually understanding, okay, exactly what price point are we referencing. Where it's like, for me, I reference the open to the low. That's an order block. It's not, oh no, it's this down close candle, this up close. No, it's more specific than that. And the same with fair value gaps. It's not, oh, it's a gap. No, it's the difference between this candle's low and that candle's high. And then specifically, okay, what's the algorithm referring to in that range? Not just blindly drawing out some box or some line. So that nuance, wanting to understand things in such a nuanced way has helped me to, find some really cool looking things and have a better understanding of some things. But at the same time, maybe it'd be easier just to draw a box on my chart and be like, buy. Sometimes, maybe if I have all the narrative and alignment correctly, and maybe if I'm very confident that we're going from here to here, which I was, then maybe that's a time to turn off the analytical part of my brain that's trying to, really get everything absolutely dialed, and just think, okay, well, this is a fair value gap. Okay, this is a mitigation block. Okay, now we've got a breaker block. Just start doing that kind of stuff to some extent. But they should only really be used when we are in a very clear one-directional price move where down close candles will support price, and fair value gaps should reduce price. And so when I can identify that, okay, we are in a fast-moving environment, this is a great thing to do.